Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us to learn about S&P TSX 60 Index Mini Futures trading under the symbol SXM. Futures are contracts to buy or sell a product at a specific price on a specific date. The futures contract will either call for physical settlement or, in the case of futures on indices, cash settlement. There is one buyer for every seller of a futures contract, and as a result, if a position is not closed before expiration, both parties must fulfill their contractual obligation on the settlement date. It is important to understand the differences between the options market and the futures market. Remember that the option buyer has a right but not an obligation to take possession of the underlying security, while the buyer and the seller of a futures contract both have obligations unless the position is closed prior to expiration. An option contract only has a value on expiration if it is in the money, while a futures contract has a value as soon as the price changes in relation to the entry price. Profit and loss is not realized in the options market until the position has been offset, while a futures position is marked to market at the end of every trading day. Finally, an option buyer pays a premium and an option writer collects a premium. No upfront cost is incurred in the futures market. However, a performance bond or good faith deposit known as margin is required. An equity index is used as a method of measuring changes in a basket of stocks representing a specific sector or sectors of the market, or the overall market in the case of a broad-based index such as the S&P TSX 60. Equity indices are often used by the media and financial services as a way of tracking the overall performance of the market or portfolios. The SXM is considered to be an equity index future. Equity index futures closely follow the price movement of their respective indices, which is typically referred to as the underlying or cash indice. There are key differences between the cash and futures market. The cash market, which is also known as the spot market, is not represented by one central location and is made up of a network of buyers and sellers, whereas the futures market is traded at a central location known as an exchange. The cash or spot price reflects the index value under current market conditions, while the futures market reflects the spot price plus the opportunity cost that arises from the delayed settlement. The cash or spot price reflects the immediate settlement and delivery. In comparison, the futures price includes a cost of carry, such as financing, or in the case of a physical product, such as grain or oil, storage and insurance. Finally, participants in the cash market usually assume the risk of counterparty default, while the clearing corporation assumes the risk in the futures market. SXM futures are valued based on the S&P TSX 60 index, which tracks the 60 largest companies trading on the Toronto Stock Exchange. The index includes companies from 10 industry sectors, including materials, financials, consumer discretionary, telecom, healthcare, industrials, energy, consumer staples, utilities, and information technology. The S&P TSX 60 represents an approximate market capitalization of $1,144 billion, which is about 73% of Canada's equity market capitalization. The index provides insight into the overall direction of the Canadian equity market, which can help guide investment decisions. As mentioned, SXM futures are priced in relation to the S&P TSX 60. Each contract has a multiplier of 50 Canadian dollars times the current level of the SXM contract value. For example, if SXM futures are priced at 800 index points, each contract would be worth 40,000 Canadian dollars. The minimum price fluctuation for a futures contract is known as a tick. One SXM tick is worth 0.10 of a full point, which is valued at 50 Canadian dollars. By multiplying 0.10 times 50, it can be determined that each tick movement is worth 5 Canadian dollars. This chart reflects the profit and loss for one SXM contract at different index levels. Notice that as the index increases in value, the long futures contract profits and the short position reflects a loss, while as the index decreases, the long contract loses value as the short contract profits. SXM futures contracts are tradable in the early session from 6 to 9:15 a.m. Eastern Standard Time. The market then reopens for the regular session and trades from 9:30 a.m. until 4:15 p.m. Eastern Standard Time. SXM Futures have quarterly expirations with March, June, September, and December expiration months available for trading. SXM contracts are settled based on the official opening level of the S&P TSX 60 index on the final settlement day, which occurs the third Friday of the contract month selected. As a result, the last trading day for expiring contracts is the day before. SXM Futures allow investors to take advantage of a directional bias on the Canadian economy with a single transaction, employing leverage of 4 to 15% of the overall contract value depending on market conditions. This also becomes a cost-effective way to hedge a portfolio of broad-based stocks during periods of market concern. Finally, experienced investors can take advantage of index arbitrage, trading an observed discrepancy between the S&P TSX 60 index and the theoretical fair value of the SXM Futures contract. For more details and examples, please view our strategy-based videos.